You're listening to the Quint's podcast.
Act of God or not, even though India was expected to see a considerable economic slowdown, the contraction of the GDP by 24% in the first quarter of the current financial year is coming off as quite a shocker. All thanks to this, India, once the world's fastest growing major economy, now seems to be headed for its first full year contraction since 1980. With economic activities almost brought to a standstill due to the nationwide lockdown to curb COVID-19 that was imposed in the initial months of the pandemic, some sectors like manufacturing and construction, which create the most number of jobs in the country, received a heavy dent. But experts warn that the figures may not be able to reflect the true extent of damage, especially since the informal sector was more affected than the organized sector. With outputs at a severe low, unemployment on the rise and incomes falling, experts also believe that it might take not months, not a year, but several years to recover from a slump-down of this magnitude. So are we sliding into a recession? What is the root cause behind this crash and what is the road to recovery? You're listening to The Big Story, the podcast where we dissect the headline-making news for you. And I'm your host, Shorburi. Barring agriculture, which grew at 3.4%, all the other sectors of the economy saw a major drop in their incomes. If you look at the figures, construction dropped by minus 50%, manufacturing by minus 39.3%, trade and commerce by minus 47%, the mining sector's growth also dropped by 23%, and estimates by most economists suggested that a contraction between 18 to 20% was certainly expected in the first quarter, but this is the worst slump since India began publishing quarterly numbers in 1996. While there are reasons to believe that economic activities began picking up in this quarter as lockdown restrictions were eased, as the country gradually becomes the global hotspot for COVID-19, this drop in growth reveals the extent of the damage that the pandemic has caused to the country's economy. But is this a shocking drop or was this not entirely unexpected? Let's hear from economists on that. Deutsche Bank's India chief economist Kaushik Das gives his initial takeaways to Bloomberg Quint.
Yeah, so we had a forecast of about minus 20%, and the range was between minus 15 to minus 25 if you saw the Bloomberg consensus forecast range. So it's not that surprising for the market, so it could have been, if it was above minus 25, that would have been more shocking. But I think this is more within the acceptable range that market was working with. So it's not like that shocking in my view. The only thing is there are some bit of, uncertainty with the public spending number, which has come minus 10% YOY, which generally analysts were expecting it to be positive. If you look at the government consumption side, actually government consumption in real terms were up 16% YOY, but the public spending on the GVA side was minus 10% YOY. Which all analysts, I think, had a positive forecast, and therefore we are getting a little lower number of minus 20%. But this doesn't change the broad narrative that Indian economy has got a big shock, and it will take quite a bit of time to get out of this shock. And as economists, we would obviously see the YOY growth, but more important is to see the incremental growth, and also more important than that is to see the level of GDP, where we were in December 2019, and from there how much we have fallen and how long it is taking us to reach the December 2019 levels and then surpass it and grow. So from that perspective, I think we have a long way and a bumpy kind of recovery path going forward.
And this is what Rahul Bajoria from Barclays told Bloomberg Quint.
So my sense is, as Kaushik, I think, summarized it, that this is quite a shock and not a big surprise. Given the range of estimates, I think the area of disagreement probably within economists was more about the impact of the way we measure our GDP, not so much about the magnitude and the nature of the shock the economy was facing. I think it is fair to expect that the levels of activity will improve, but then at the same time, we have to be cognizant of the fact that the health crisis is something that is still very much with us. The numbers are increasing, and that is probably going to have almost a commensurate impact on discretionary activity. So while essential services, there's been a broadening in the way the lockdowns and then the unlocks have been operating. But certainly, I would not celebrate the fact that there will be a pickup in activity and the GDP numbers in the second quarter of the fiscal year. What you have to kind of look at here is the level of activity, which I think will continue to remain relatively modest compared to the pre-COVID levels. So there's no reason for the government to take any kind of solace from the fact that activity levels.
According to the data released, consumer spending, private investments, exports, all of it has suffered enormously. If you look at the unemployment data, since the pandemic broke out, the overall national unemployment rate was recorded at 8.3% in August. And that's according to the data provided by the Centre for Monitoring Indian Economy, or CMI. A more recent data from CMI also shows that at least 18.9 million salary jobs were lost despite the recovery in overall employment rate, which is driven by the informal sector. The CMI also said that the job losses among the salaried classes are a ballooning cause of worry because, and I'm quoting the report, quote, while salary jobs are not lost easily, once lost, they're also far more difficult to retrieve, end quote. With a sharp drop in incomes, private individuals are cutting back on their consumptions, which is also cutting back on business investments. And all of this begs the question, are we headed towards a recession? The Quint's editorial director Sanjay Pugalia explains.
Yes, this is almost certain that we are heading towards recession. Technically, recession is called when there are 2 quarters, consecutive quarters of negative growth. Then it is technically called recession. But this fall, this contraction is much deeper than that technical definition. Second quarter is going to be definitely in a serious negative zone. Overall growth of this year is going to be in negative zone. So yes, it is a complete recessionary trend.
While talking about this, what is also worth noting is a different set of figures from the same day that showed that the Modi government breached India's full-year fiscal deficit target in April to July as the coronavirus pandemic continued to hamper the government's revenues. According to a Bloomberg Quint report, the gap between the revenue and the expenditure is at Rs 8.21 lakh crore or 103% of the budgeted estimate during the reported period. Compare that with a deficit of 79% of the budgeted target in the year-ago period. On that part, the states and the centre did try to shield the economy from collapsing a little by spending more, and as a result, the government expenditure grew by 16%, but it nearly doesn't cut close to addressing the loss of demand and labour. But at a time of such a contraction, what this vital fiscal deficit also means is that the government's ability to spend more is also reduced. When in 2008 the world was hit by a severe economic recession, India managed to hold its ground. So why isn't the current government taking drastic measures to help the ailing economy now? And we go back to Sanjay Pugalia here.
I think one explanation is that government is waiting to see that infection curve peaks out. That is why they are not using all the resources they have in their hand. But they do not have any resources. Their tax collection is down. They have almost hit the ceiling of expenditure, and fiscal deficit numbers are not looking great. So, and the government doesn't have the idea how to revive the economy, and to do that, how to borrow, when to borrow, and if you hit the ceiling of borrowing also, you should go for monetization. That simply means printing the currency. So government is kind of waiting and watching this situation, and it is getting worse and worse.
Just a few years ago, India was one of the world's fastest growing large economies, recording a growth of beyond 8%. In fact, in the pre-corona times, in 2019, India was fifth in line with a $2.9 trillion economy, only behind the United States, China, Japan and Germany. But by next year, experts warn that India's economy is expected to shrink by at least 10%. And the figure of minus 24% from Q1 is crucial now because it's the first real measurement on the state of the economy since the pandemic hit. But with the coronavirus infections ever on a rise in the country, Kaushik Das says that it's hard to estimate when India will return to normalcy.
We don't know how long it will take for normalcy to come back, because what happens is when you do an unlock 3 or unlock 4, and as mobility increases, there are risks of COVID-19 cases to also increase. So we don't know whether it will be a stop and start kind of an economy. And in 2 months' time, when we have more mobility, after some time you may see again numbers moving up, which may lead to further lockdown. So this is something which is going to stay with us for a long time till we find a vaccine or a cure. So we would be very cautious about drawing conclusions, even if we were to take a positive view of this government consumption going forward. We would be cautious about the growth outlook overall. And the other thing which I can think of, I don't know whether that makes sense or not. April, June last year, government in a normal year were much more proactive in pushing kind of spending. This year, April, June, they themselves were kind of caught in this lockdown and they could not push spending that much. But this still doesn't explain why there would be variance between the public spending and government consumption so much, and why such a variance between -10 and +60.
The hyped up 20 lakh crore economic package provided by the government had provided immediate relief in the form of tax deferrals, cash transfers for the poor, and regulatory restraints. So what about that? Is that not helping? Well, the free ration will only be provided till November, and as of 31st August, the 6-month moratorium period to provide relief to borrowers also got over, which means NPS could also rise. So in the middle of all this, what is the road to recovery? What does India need to focus on to boost its recovery? Mr. Pugalia weighs in.
Before recovery, it is about stalling the slowdown, the deep fall that we are in. And government seems to be doing nothing. The important point is to make sure that there is a demand creation that happens only when you put money in the hands of people. For that you need to borrow or print the money. Till you do that, you cannot revive the economy. The past economic relief packages were relief packages and they were also not adequate. They thought we will create liquidity, we will give credit and economy will sustain itself. That has simply not worked.
If you like listening to this episode, please subscribe to the Big Story playlist for episodic updates. We're live on Apple, Google Podcast, Spotify, JioSaavn, and most of the other popular podcast streaming platforms. For other podcasts, please log on to the Quint website and check out the podcast section. For any feedback, shoot an email to podcasts@thequint.com.
Thanks for listening. Log on to the Quint's website and check out our other podcasts.